When you talk about meltdown, you're talking about another Lehman event or something worse?
Well, no, what I think of is, I think of something worse. I think of people losing confidence in the banking system and in governments. Because a lot of the banking problems have been transferred to governments now. And of course, the government would be translated by interest rates going to very high percentages, which of course would create bigger deficits than we already have. And finally, someone will throw up their hand and say, we just can't deal with this, and there'll be some kind of financial collapse. And my ultimate expectation is that people will realize that having money in banks is a risky proposition for no return. You get paid nothing to have your money there. Why do you take that risk? If you had money in Dexia and the governments hadn't come in to bail you out, you as a depositor would have lost money. And it's not worth getting 0.1% a year or half of 1% a year to take that kind of risk. And as people gradually come to that determination, I think the money will come out of banks and go into precious metals.
Well, that's an important point, because I think people already understand the inflation risk, but what you're basically suggesting is that people are only now starting to come to grips with the counterparty risk.
Sure. And of course, we've seen it manifested. We've seen examples of companies who've, I don't know if they've announced it, but it's become public information that they've taken their money out of the banks. And I think thinking people realize that there's a risk element because, of course, of all the counterparties, things that you've talked about for a long, long time. And, you know, once this thing gets ahead of steam and everyone's trying to put it with the top bank, all the lower level banks, of course, lose their deposits. They have to sell something. Well, as it turns out, there's nothing to sell. I mean, you want to sell a stock and it's down 25%. You want to sell a European government bond and it's down 10%. And of course, they don't want to throw up these losses on their income statement because it'll become more apparent that the capital's at risk. So they're in a precarious position where normally they have to fall back on governments now to inject money into the banking system.
But that's the liquidity event that you spoke about in your presentation this morning, describing the Lehman collapse as
right.
But so you see this ultimately recurring?
It almost has to recur. And it's only a question of why does it recur? Does it recur because, you know, they actually go to austerity? Does it recur because people just lose confidence in financial instruments and paper money? And it looks now like the more likely thing is they're going to lose confidence in the banking system and paper money.
Well, it also recurs because of the point you made this morning about the leverage in the system. That, you know, there's, as you explained,
yeah.
There's just too much leverage.
Yeah.
So
the average person doesn't appreciate the leverage, though. I mean, the average guy
or the danger of the leverage.
I don't know. He has no idea. I mean, yes, analysts would understand what the leverage is, but I don't think the average person would. What they would probably understand is if, for example, we had another Dexia soon, then people would start linking things together. Maybe we could say that MF Global was the same as Dexia. It's not really because it's an investment dealer, but you know, if you had another situation where all of a sudden some bank has to be taken over by governments, maybe people start connecting the dots and say, well, who's next? And you know, what's my risk of losing money in the banking system?
Mm-hmm. So in terms of the banking system, that's inherently what you called the fundamental flaw?
Sure.
The fact that it's just too highly leveraged?
Yeah, well, I mean, as I pointed out, you know, in a 20-to-1 leverage, and I think, for example, banks in Europe are more than 20-to-1 leverage. If you have $1 of assets, you can only lose 5 cents before you have zero capital. And when, for example, on the typical Friday night in the US, when a bank goes down, they actually lose 30 cents in the dollar. So they're losing their capital 6 times over. I mean, what's the chances of not losing 5 cents in a $1 investment, no matter what you're in? Government bond, mortgage, investing in the stock market. I mean, that's almost a daily occurrence.
Particularly given the fact that prices were bid up so high in the previous boom that they reached levels that were just not sustainable, price levels that were not sustainable.
In many things, whether it's housing or various financial, the whole derivative thing that is so complicated. I mean, you know, the level of derivatives that aren't even on the balance sheet is staggering.
Yeah.
So even when you're looking at 20-to-1, you have no idea whether it's really 20-to-1 anyway.
Yeah.
It could be 50-to-1.
I'm not even getting to the derivatives. It's bad enough just looking at what's more or less visible in terms of the way the banks report numbers.
Totally.
Speaking of which, when I first was trained as a banker back in the late 1960s, it was prudent to have a loan-to-deposit ratio of about 0.7, 0.75. So in other words, you had more deposits than you had loans. I don't know if you're aware of this, but in Europe now, the loan-to-deposit ratio is 1.2, which just goes to show how sensitive these guys are to funding needs, and it explains why these guys are so panicked, because the traditional funding sources, money market funds from the US and things of that nature, have been turned off. So in order to get from a 1.2 loan to deposit ratio to a 0.7 or even a 0.8, a lot of assets have to be sold. Now those assets are not going to be sold anywhere near their face value, which means that a lot of losses are going to be taken, and that's going to erode capital bases. So
and I guess there's no one to sell them to.
Yeah.
Because everyone's doing the same thing at the same time, right?
Yeah.
Banking systems throughout the world are too levered. So who's the ultimate buyer? I guess the government can be the ultimate buyer, which has already happened, right? In the sense that they'll buy your sovereign debt from you here in Europe. They'll let you sell sovereign debt, and the Treasury buys Treasury bonds. And that's been one thing that's happening, that the banks are able to at least sell the bonds because in essence, the regulator comes in to buy them.
Well, the banks can try to move the assets around to make them believe that make the market believe that those assets have disappeared, but they really haven't. And one of the things we're seeing on both sides of the Atlantic is not only the quantitative easing by the central bank, but the qualitative easing, in the sense that the central banks, by buying a lot of these assets, the Greek debt that isn't really worth anything, and now the worries about the Italian and the Spanish debt, the quality of the assets on the central bank of the ECB, and even the Federal Reserve did this with a lot of the mortgage paper that they've bought. This qualitative easing on the asset side is just as harmful as the quantitative easing on the liability side by increasing the quantity of money.
And of course, there's no accounting for that, right? Because who would even deem to question the Fed or the ECB, even though people like yourself and myself realize exactly what's going on? But obviously, the average guy in the street doesn't even think about it. They don't even look at banks, let alone the central bank. And so there's this almost license to be irresponsible, which of course, having been given the license, they've used the license. But there's no question that, I mean, as these central banks get involved in buying bonds, they're just losing money.
Yeah.
But there's no accounting for it.